Hello everyone. RRSPs are a great way to save on taxes, save for the long run. However, RRSP is also an area where a lot of people do not have any information on how they work, and there is a lot of misinformation out there. So I'm going to try to explain this all to you. I'm going to go over what RRSP limits are, what are the tax benefits of RRSP, what happens when you withdraw the money out of your RRSP before retirement, what happens at age 71, what happens to investments in your RRSP, and finally spousal contribution. So first part is the limit. Limit is the easiest way to explain. Limit is how much you can put in your RRSP. Anything you put in excess of your limit, the government will charge you a penalty on this amount, and this penalty is 1% per month for every month you have the money in there, and you have to file an additional return. I believe it's called the T1 OPP return. So the penalties can add up. I've had a client who filed a T1 OVP return where they had to pay almost, I believe, $15,000, $16,000 in taxes because they left the money in there for so long and they never realized it that they had that money in there. So make sure you do not put in excess of your RRSP limit. You can find out your limit from your notice of assessment from CRA's website, or you can ask your accountant if they are able to pull that up from the CRA's website if they're your representative. Second part is tax benefit. To explain the tax benefit, I'm going to use this chart here. So look at this chart here. These are the tax brackets. So if you have employment income in Canada, we have a marginal tax system. So what that means is the first 42,000 you pay 20%. After 42,000, every dollar you make between 42 to 46, you pay 24. Every dollar you make from 46 to 75, you pay 29, and so on. Now, when we do your taxes as accountants, we calculate your taxable income. First, we calculate your total income, net income, taxable income. Taxable income is the income that we use to compute how much taxes you would have to pay. Taxable income is what the government looks at to know how much taxes this individual has to pay. When you make income and you make an RRSP contribution, it gets deducted from your total income. And that means that money goes in tax-free because you don't pay tax on it. So what that means is, let's say for this person, let's say this person makes $230,000 a year. Every dollar they're making after 220, they're paying 53% tax. They're still paying 20% on the first 42. They're still paying 31% on the first 75. So if we average out their taxes, it's not going to equal 53%. So a lot of people, they get confused that, oh, I made so much money, I'm going to pay 53% on the whole thing. No, it's basically what is after that bracket. So if for 230, the last 10,000, they're paying 53%. So essentially, let's say that extra 10,000 is what we're going to work with. So from that 10,000, let's say they filed their taxes normal. What did they get to keep from that 10,000? So from that 10,000, what they got to keep is basically 46.47%, which is they only got to keep $46,470. I messed up on this, so times 10,000. So they got to keep 46.47. So let's say they're trying to save for retirement, and they are saving it in an account after taxes. So to reach the 10,000, from that 10,000, they're only able to save 4,600 because they paid 53% in tax. Now, instead of saving it in a non-registered account, they decide that, you know what, I'm going to put it in an RRSP. Now, when they put that money in the RRSP, that 10,000 goes in tax-free. That means they don't pay any taxes on it. When we calculate their taxes, we're going to assume their income is $220,000, not $230,000. So they get to keep the full $10,000 in that account. And usually what happens is, because you're working at an employer and they take out taxes every time they pay you, they've probably taken out, taxes based on that 53% rate for the last 10,000. So when you make that contribution, you file your taxes, you get an extra $5,300 in refund. That just means you're getting your own money back. But, if for a contribution of 10,000, you got $5,300 in your hands today, technically, if you hadn't made the contribution, you would have had $4,600 in your hands today. Now, that sounds great, but how does the government get the taxes on that income, and how can you save on taxes from RRSP? Is the idea is to put the money when you're in a high tax bracket and take out the money when you're in a lower tax bracket. So I want to put in money when I'm making 200,000, and I want to take it out when I'm making 40,000. So let's say the same individual that we're talking about who made this 10,000 contribution in 2018, and they lose their job in 2019, and 2020 was a bad year. They made only 30,000 in income, so they had to take money out of their RRSP. Because they took it out when their income was, so when they do their 2020 taxes, and they compute their like the accountant computes their taxable income, they're gonna have 30,000, let's say, as employment income, plus 10,000 as RRSP income. So what that means is their total income is 40,000. They're in this bracket. So on that extra 10,000 they took out, they only paid 20.5% in taxes. So what that means is if they hadn't put the RRSP money in, they would have paid 53.53, so 55,353 in taxes. But because they put it in there when they were making more money and they took it out when they were making less money, they were able to save $3,348 in taxes. So again, the idea is you put it in when you're making more money. You don't have to look at 220. We can look at 89 to 93,000. You put it in when you're making more money. You take it out when you're making less money, or you take it out when you retire, because when you retire, normally the assumption is you're going to be making less money. So that's how you can save on RRSP. A lot of people who I see them, they make mistakes where they start working. They're making, they just came out of university, came out of college. They start working. They're making, 50,000. Somebody tells them, oh, best way to save on taxes is put money into your RRSP. Okay, they go put 5,000 in their RRSP. At 50,000, the first 4,000 they get 29% back. The last 1,000, I'm just rounding, they get 24% back. They put that money in there. Then after, let's say, a few years, they get married, and they're now making 150,000. Let's say they're making 144 to 150, and because they have a lot of expenses, they got to pay for, so they take the money out of the RRSP to pay for their expenses. What happened here is when they put it in, they got a tax saving of, let's say, average 27%, and when they took it out, they paid around 43 to 46%. So essentially they paid more in taxes because they put the money in when they were making less, they took it out when they were making more. So sometimes, if your income is going to grow over the years, you might want to save your RRSP contribution room for a time period when you are making more money and you get more money back for your RRSP. The other advantage of RRSP is also for first-time homebuyer amount, which I'm going to make a separate video because then this would get way too long. But you can withdraw out of money, lump sum out of your RRSP as a first-time homebuyer to save money there. I'm going to skip investments and go to spousal contribution. Spousal contribution is another way you can save money on taxes. Spousal contribution, how it works is, let's say I'm doing a spousal contribution for my spouse. So let's say I take 5,000 and I put in my spouse's RRSP. I have to let the bank or whoever is doing my RRSP know that this is a spousal contribution. What that means is it's going to go in my spouse's RRSP account. It's going to be under her RRSP. It's going to be under her name. However, the deduction I'm going to get, it's going to come on my return. The RRSP contribution room, the limit that I spoke about earlier, is going to affect my limit. Why would somebody do that? Is because let's say my spouse makes, there's a few reasons. So one simple reason is, let's say my spouse is a part-time earner. She doesn't make as much money. I make more money, and I pay, let's say, a high tax rate. Like let's say I pay the 50% tax rate, and my spouse normally averages around 42, so she's paying around 20% tax. Now, when I make the RRSP contribution under my spousal contribution, if I keep the money in there for 5 years, when I take that money out, it's going to be part of my spouse's income. If I take it out before that, it's going to be my income. But if I take it out after 5 years, it's going to be my spouse's income. So let's say like in retirement, or let's say in the future, my spouse's income is low and I take my 5,000 out. So, I went from 52% to 20%. So, I saved in taxes there. So some people, they do it like that. The other method is, in terms of retirement. Let's say my spouse has a very good retirement pension plan. I have no retirement pension plan. Then when we do the RRSP contribution, my spouse will do a spousal contribution for my RRSP, and I would do my own. Let's say both of our income is equal, But the benefit of my spouse doing a spousal contribution in my name and I'm doing my own contribution is we both get to deduct the RRSP contribution. If I do the full amount, so let's say we both make 46 to 75, we're paying 29%. Let's say we are both our RRSP our total income for the year is 47,000, and we have 5,000 to spare to put in our RRSP. If I take that full 5,000 and put in my RRSP, I'm going to get 29% up to 46, and then after that I'm only getting a tax break of 24%. However, if both of us have the same income and we both put 2,500 each, we'll both get a 29% tax break, but because she's doing a spousal contribution, it will go in my RRSP. And then in retirement, when I take the money out or when I buy a RIF, I'm going to get the retirement income from both our RRSP contribution, and she has a good retirement pension plan, so she gets the retirement income from there. So we're essentially income splitting, or if we didn't do it like that, then the income would be added on to her. There is still an income splitting. You're still able to split your pension income. However, laws change. If you're 30 years old right now, we don't know if the pension splitting rule is going to be there when we retire. So that's why it's good to plan ahead in case of worst case scenario. The last part is the investment. So what happens when you put the money in your RRSP? So when you put the money in your RRSP, you have a few options. It's basically like an investment / bank account. You can keep it in cash there. You can buy a bond. You can buy GICs. Or you can trade stocks. You can buy Apple. You can buy mutual funds. You can buy ETFs. There are some limits on certain things you can't buy, but a lot of the normal day-to-day stuff you can buy. Any income you make on that is going to be tax-free. So let's say I bought Apple shares and they grew from 5,000 to let's say 10,000. That extra 5,000 in capital gains I had, if it wasn't in my RRSP, I would have paid tax on it. Or if I had $100 in interest income, it's in the RRSP, it's tax-free. However, when I do take it out eventually, so let's say, over my life, I contributed 30,000 my RRSP, and that 30,000 grew to 60,000. When I take it out, I pay tax on the full 60,000. Hopefully this video was helpful. I just want to kind of clarify how RRSPs work and help explain how you can benefit from it. So in summary, you want to put the money in when you're making more. You want to take it out when you're making less. Most people make less in retirement, so that's why the government's saying, hey, we'll help you save faster. So you can put your money aside tax-free today, and then when you take it out, you pay tax on it. So to save 5,000 for this person making 230, to have 5,000 in his hand in their savings account today, they would have to make a lot more to get 5,000 saved up if they were saving after tax income. But because they're putting it in their RRSP and they're saving pre-tax income, they get to put that 5,000 in tax-free. And usually their employer is taking out taxes when they're getting paid, so they get a nice refund at the end of the year. Usually their refund is almost, if their employer is doing the right amount of tax deduction, they get almost like the rate that you're looking at over here in terms of refund. But even if they're not getting a refund, they're still saving on taxes. And sorry, I'm just going to jump here. One more thing is when you withdraw money out of your RRSP, the bank's going to withhold some tax. So if you withdraw, let's say 5,000 to 15,000, they withhold 20% taxes. And a lot of people get spooked by this number. But remember, this is withholding tax. It doesn't mean this is the taxes you're paying. The taxes you're paying is going to be calculated based on your total taxable income for the year. Your taxable income can be zero, and the bank withheld 20%, and you had to pay total taxes of zero. You're going to get that full 20% back as a tax refund. This tax withheld tax deducted is basically like when you get paid from your employer. If you're making 90,000 a year gross salary, doesn't mean you get your net income in your hand 90,000. They take out CPP, they take out withholding tax. So the withholding tax is basically the same thing as when you get paid by your employer. Thank you for watching. If you have any questions, please feel free to reach out to me, and I wish you the best.